Okay, welcome back. So in this video, we're going to continue on to part B of the 2002 depreciation of fixed assets question. And part B is the provision for depreciation account. Now, a big part of this entire question is doing the depreciation workings for the question. It takes pretty much as much or more time than writing out the accounts themselves. So in this video, we're just going to do the workings for the provision for depreciation account. And in the next video, then we'll use those workings to create the account itself. So the workings for the provision for depreciation account are basically all of the annual depreciation for each of the years from the very first year you bought a vehicle or the company bought a vehicle, 1996, straight through to 97, 98, 99, 1000 or 2000 rather, and 2001. So it's just the annual depreciation for each of those years, the depreciation amount that you would put into the trading profit and loss under depreciation of vehicles each year in the expenses. So in order to do those workings, different teachers have different methods of how they lay out the workings. There's no one right method to lay it out. This is how I tend to do it. I make out a grid similar to this. I tend to have one narrow column at the start. We'll see why it's narrower in a second. And then I have some equally sized columns afterwards, one for the cost of the vehicles, one for the annual depreciation, and then one for the depreciation on each year from 1996 up until, in this particular question anyway, 1996 up until 2001, and then a total column at the end. So without further ado, let's just label these columns. So I label this first one number, and then this is going to be cost. This is going to be annual depreciation. Then we're going to start with 1996, so 96 for short, 97, 98, 99, 2000, 2001, and then there's the total column at the end. Okay, so the next thing is this number. The number column refers to the number of the vehicle. Now, in this case, there were 3 vehicles that were owned up until the start of 2000, up until the start of the year 2000. There was vehicle number 1, number 2, and number 3. Then, as we saw in the first part of the question, we got rid of one vehicle, number 3, and we got another vehicle. Now, that new vehicle I'm going to call vehicle number 4. And then in 2001, we got rid of vehicle number 1 and we purchased another new vehicle, and I'm going to call that vehicle number 5. So we're going to have a 1, 2, 3, 4, 5, but also we have this refrigeration unit that was depreciated, and it was attached to, where is it? Vehicle number 1 had a refrigeration unit fitted, so it's attached to vehicle number 1. So what I'm going to do is I'm going to write it out like this. I'm going to say vehicle number 1, then I'm going to write out unit for the refrigeration unit that's attached to vehicle number 1. So I'm putting it right next to the vehicle number 1 line. Then I'm going to go for 2, 3, 4, and 5. Then what I'm going to do is I'm going to write down the cost of each of these vehicles in this column. So vehicle number 1 was 66, number 2 was 72, number 3 was 78. So 66, 72, 78. The unit had cost 16,000 when we bought it first day. Then vehicle 4 and 5, well, vehicle 4 cost 96,000 and vehicle 5 cost 90,000. Now, it doesn't matter what you actually paid for any of these, it's the overall cost of these new vehicles. Like the check for vehicle number 4 was 57,000 because you traded it in when you crashed vehicle number 3, you traded in vehicle number 3 and got a discount. But the actual price, the cost of it was 96,000, and the cost of this one was 90,000. 96,000. 90,000. Okay, so in the next column, we're going to calculate what the annual depreciation would be on each of these items, these fixed assets, if we were to pay a full year's depreciation, or if we were to charge, I should say, a full year's depreciation, since we don't actually pay depreciation. So here we see that the annual depreciation is 15% of cost per year. So if I work out 15% of 66,000 first, is 9,900. I'll skip the unit for a second. I'm going for 15% of 72,000 for this one. 10,800. 15% of 78,000 next. 11,700. 15% of 96,000 is my next one. 14,400. And 15% of 90,000. 13,500. Now, the unit is a little bit different because if we read down here, it says the unit was depreciated at a rate of 30% of cost for each of the first 2 years, and after that 15% of cost per annum. So I'm going to work out what 15% and 30% of that 16,000 is. So first of all, 16,000 multiplied by 0.15. 15% is 2,400, so 30% must be double that, 4,800. So I'm going to write 4,800 here and 2,400 because the annual depreciation changes depending on the year question. Okay, now at this stage, I want in some way to differentiate the first 3 columns from the rest of the columns here, because when I'm doing sum totaling over here, I don't want to accidentally include any of these figures in the totals, because when I'm totaling across, I'm only going to be starting from this column and going all the way over to this column and then getting my total. So it could be a habit or an accident that happens that you include this when you're adding those, or you include both of these, even it has happened in the past. So in order to differentiate between the two, my recommendation is that you maybe do these in a different color pen. So I'm going to switch pens then, or now, in order to do the rest of this grid. Okay, I got a blue pen here. So we're going to start with 1996. Now, in 1996, you owned, or the company owned, just one vehicle. These ones hadn't been purchased yet. These other ones hadn't been purchased yet. The unit hadn't been purchased yet. So we're not going to be calculating any depreciation for this, or this, because we didn't own them yet. Okay, so the only one we're calculating depreciation for is this first vehicle that you owned. And if you bought it on the 1st of the 1st, 1996, it means that you had it for the entire year 1996, which means that you will be charging a full year's depreciation for that vehicle in 1996. So it's 9,900. Now, we will total each of these columns down here, but not any of these first 3. So our first total here for 1996 is going to be 9,900. Okay, then we move on to 1997. Now again, in 1997, we still, we had only bought one more vehicle in 1997. We didn't own vehicle number 3 or 4 or 5. The refrigeration unit didn't come till 1998. So this time we'll only be depreciating vehicle number 1 and vehicle number 2. So the unit still isn't there. We didn't have vehicle number 3, 4 or 5. So vehicle number 1, again, we owned it for the entire year of 1997, so it's going to be a full 9,900 depreciation. Vehicle number 2, however, we only bought that on the 1st of the 9th, 1997. So we didn't own it for the entire year of 1997. In fact, from when we bought it on the 1st of the 9th, there were, there was all of the 9th month. This is the way I would do it. All of the 9th month left to go in the year. 10th, 11th, 12th month. There was 4 months left to go in the year. So you owned it for 4 months of 1997. So if this 10,800 is a full year's depreciation, then to get 4 months, then all we have to do is take that and multiply by 4/12. So doing that here, 10,100 multiplied by 3,600. And then our total depreciation that we'll charge for the year 1997 is going to be 13,500 if we add the two of those together. Okay, so moving on to 1998. Now in 1998 we owned vehicle number 1 still. We haven't gotten rid of it or anything yet, so it's going to get a full year's depreciation. We have at this stage purchased the unit. If we look at this, on the 1st of the 1st, 1998, we purchased the unit costing 16,000. So since we purchased it on the 1st of the 1st, it means we'll own it for the entire year of 1998. And for the first year, it's depreciating at 30% at the higher rate of depreciation, which in this case is 4,800. So we'll put in the full 4,800 here. Vehicle number 2, well, we bought it partway through 97 and then we owned it for all of 1998. So a full year's depreciation in 98 would be 10,800. Okay. Vehicle number 3, well, we're in 1998 and we can see here that we did buy vehicle number 3 in 1998, but we didn't own it for the full year. So we purchased it on the 1st of the 3rd. That means 2 months had gone by and the 3rd month was just starting, the 1st of the 3rd. So if 2 months had gone by, there were 10 more months left in the year. So if a full year's depreciation is 11,700. We want 10 months worth, we just have to multiply by 10/12. So 11,700, 9,750. And vehicle number 4 had not been purchased at that stage, and vehicle number 5 had not been purchased at that stage. So now we just need to add up these 4 figures to get our total depreciation for 1998, and that's going to be, let's see, 10,800, 4,800, and 9,900, 35,250, 35,250. Okay, so moving on to 1999 then. Again, remember all of this stuff here just happened in the year 2000 and 2001. So in 1999, we owned number 1 for the full year, so full year's depreciation here. The unit, we owned it for the full year as well, and it's the first 2 years we depreciated at the 30% rate, so it's again the higher rate. Vehicle number 2, we had it for the full year, so it's the full 10,800. And vehicle number 3, this time we had it for the full year. We purchased it partway through 98, so we had it for all of 99 then, and that's 11,700. We still haven't purchased vehicle number 4 or number 5, and now we just need to tot up those figures again, those 4, so 99 plus 4, 8, plus 10, 8, plus 11,700, and that gives us 37,200. Now, at this stage, we are going to add up the depreciation for these first 4 years. Now, we'll explain when we go on to do the, in the next video, when we go on to talk about how to do the provision for depreciation account, why we're interested in this figure, which is the total depreciation for those 4 years, or the accumulated or aggregate depreciation for those 4 years. So it's 37,200 plus 35,250 plus 13,500 plus 9,900. That's 95,850. So 95,850, and that's for all of those 4 years. Okay, so next thing we're moving on to then is for the year 2000. Now, in the year 2000, if we look first of all at what happened, vehicle number 3 was gotten rid of and vehicle number 4 was purchased. So that means the vehicle number 1 was there for the full year. So we can give that a full 9,900 depreciation. Full year for the unit, but it was for the first 2 years was 30%, and thereafter it was only 15% depreciation. So now we're moving to the lower amount of depreciation. It was vehicle number 3 that was gotten rid of, so we still had vehicle number 2 for the full year, so a full 10,800. And we are not going to have bought vehicle number 5 yet until 2001, so there's not going to be any depreciation there. So we're just worried about vehicle number 3 and vehicle number 4. Now, vehicle number 3, it says, on the 1st of the 4th was crashed and disposed of. So the 1st of the 4th, 2000 means that you had it for the first 3 months of the year 2000 before you got rid of it. So if a full year is 11,700, and you only had it for 3 months of the year, if we multiply that by 3/12, you get 2,925 in depreciation. And then vehicle number 4, which we purchased for 96,000, well, if we got that on the same date that we got rid of vehicle number 3, which was the 1st of the 4th, 2000, well, if 3 months had gone by, then there were another 9 months left in the year, so we owned this new vehicle for the remaining 9 months of the year. So that's going to be depreciation for a full year is 14,400. So for 9 months, it's by 9/12. And that's 10,800. So 10,800 here. And then we tot this up again. So all 5 of those figures now are 10,800 plus 295 plus 10,800 again plus 2,400 plus 9,900, which gives me 36825. 36825. And now we're moving on to the year 2001. So in the year 2001, we're going to find that vehicle number 1 was gotten rid of and vehicle number 5 was acquired. And the unit which was attached to vehicle number 1 was gotten rid of as well. So vehicle 1 was gotten rid of, we leave that. The unit was gotten rid of, we leave that for now. Vehicle number 2, we assume we have that for the full year, so it's a full year's depreciation. We see over here 10,800. We can fill that in. Vehicle number 3, well, we got rid of that part of the way through the year 2000, so we don't own it anymore, so no depreciation in 2001. Vehicle number 4, we got it part way through 2000, but we assume we have it for the full year of 2001 now that we own it, and that's a full year's 14,400. So now it's just the vehicles we're getting rid of, or the vehicle and unit we're getting rid of, and the vehicle we're acquiring. So if we look again at the vehicle number 1 and when it was gotten rid of, it was on the 1st of the 8th, 2001. So the 1st of the 8th means 7 months had gone by. So you owned it for 7 months of 2001 before you got rid of it. So a full year is 9,900, a full year's depreciation. But we only want 7 months. So 7/12 of that. And that's 5,775. Okay. Same goes for the unit. If a full year is 2,400, since that was attached to vehicle number 1 when we got rid of it, well then 2,400 multiplied by 7/12 will give us 7 months worth of depreciation. That's 1,400. Okay, and if we got rid of vehicle number 1 and the unit on this date, the 1st of the 8th, and on the same day we got vehicle number 5, well, if this meant 7 months had passed already, then there were 5 months left in the year. 12 minus 7 is 5, so there are 5 months left in the year, so we must have owned that new vehicle for the remaining 5 months of the year. So if we look at the new vehicle's annual depreciation, 13,500. And we get 5/12 of that, or 5 months worth, 13,500. That's 5,625. And then all we need to do is tot up the column to see the total annual depreciation for 2001. So 5,625 plus 10,830 plus 5,775 comes to 38,000 even. Okay, so that's all of that. Now, the final thing that we're going to do before we start doing the accounts is we're going to tot across this way, but we don't need to add up all of the lines going across. In fact, the only lines that we need to add up are the lines which are concerned with any vehicle or unit that we disposed of. Now, we've only disposed of vehicle number 3, vehicle number 1, and the unit that was attached to it. So it means we only have to add across this line, the unit, and vehicle number 3. And it's only the writing in blue, none of this writing in black here. So if we do that for vehicle number 1 first, there's 1, 2, 3, 4, 5 9 9s. and just multiply that by 5 plus the 5775. That gives me 55,275. And then adding this across, there's 4800, 4800, oops, 2400 plus 1400, 13,400. Okay, and finally, vehicle number 3, there are only 3 entries in this line, so it's going to be 9750, 11700, and 2925. That's 24,375. Okay, and that's it for the workings. In the next video then we'll see what we're going to use these figures for and explain exactly what these figures mean also.